I'm Darius McDermott from Chelsea Financial Services, and today I'm delighted to be joined by Matt Jarvis, manager of the Legal and General UK Property Fund. Hi, Matt.
Hi there.
Property funds have been through the mill a number of times, but the pandemic has caused some more interesting aspects with property funds, which suspended in March. Can you tell us briefly why that happened?
Yeah, certainly. So it's basically a property valuation issue that's caused the funds to suspend back in March. When property values are deemed to be uncertain by the independent valuers, then they elect to caveat their valuations with a material uncertainty clause. And under current regulations, if an open-ended fund like the L&G UK Property Fund or one of the others in that sector have more than a certain percentage of assets that are covered with this caveat on the valuations, a material uncertainty clause, then they're required to suspend on the basis that the price of the units isn't regarded as certain, and therefore if investors were to trade on that price, it would be potentially unfair for some investors. So that's really what triggered the suspensions back in March.
But that has recently reversed, hasn't it? The sort of material uncertainty clause. And does that mean property funds can open again and then stay open?
No, that's right. So as time has progressed since March, the markets have become more visible to the valuation community. And slowly but surely, the valuation community have taken the clause away, starting with things like the industrial market, where there's lots more activity. And then finally, with the retail and leisure markets, which were released recently. Now, ultimately, that has led to a significant proportion of the funds now capable of reopening because of the low levels of material uncertainty on the valuations. Now, the funds have to make a choice to reopen, and their governing bodies need to elect to reopen on the basis that they are not just comfortable that there's low levels of uncertainty, but that they're comfortable they have enough liquidity in them, and that they're comfortable with the valuations that they are seeing. So yes, the funds are generally capable of reopening, but so far we've only seen a small number that have actually taken that step.
And you mentioned liquidity there, and that's obviously a key issue with property funds, and also why the regulator is looking more closely at them, because there has been a number of suspensions in recent years, not for all funds, but for certain funds in the sector, and normally it's been liquidity reasons. What are the FCA sort of looking at, and how do you think that might pan out for open-ended property funds?
Well, certainly, just to start with, in terms of clarifying on the question, that yes, there have been some suspensions. I wouldn't say it's been widespread. You're absolutely right. There have been the occasional one that's based on liquidity, but most of the ones in recent memory have been as a result of uncertainty. And so the two issues are a little different. But nonetheless, while this current uncertainty-based suspension has been playing out, the FCA have elected to engage with the public to consult with them around the possibility of introducing notice periods on funds like this. The idea being that by having notice periods on redemptions, it would perhaps reduce the risk of liquidity-based issues, because the manager would have a little bit more time to react to a sudden change in sentiment, a sudden change in flow. Now that consultation is ongoing. We're certainly going to be taking part in that consultation, and we're suggesting to all of our investors that they should do the same to make their views known about how that affects them, what the pros and the cons are from their perspective.
And whilst it has been a difficult time, not just for property funds, let's be quite clear, all asset classes have had their ups and their downs. Why should investors still consider the asset class today? What still appeals for investors?
I mean, you're absolutely right. There are aspects of the property market, I'm not going to lie, are challenged right now. We've seen prolonged difficulty in the likes of the retail and leisure market, and right now at the tail end of the pandemic, we're experiencing uncertainty around the office markets. We're returning to office full time, but there are plenty of good areas of performance within the property market. The industrial market remains particularly robust, heavily sought after by investors, and with strong demand supply dynamic within the built environment there. So we've seen rental growth continuously through that sector in recent times. That's a very positive area. We're also seeing strength in the residential markets. The leasing side there is one that is we believe to be undersupplied with quality product. Tensions in the ownership side of the market and generally perceived to be expensive to buy, has opened up opportunity for there to be better quality rental product, and that's again something that we're looking to exploit with the UK Property Fund. So there are pockets of more robust performance. But I would say more broadly, the case for property still remains simply as a diversifier within a multi-asset portfolio. The property cycle does tend to move at a slightly different speed compared with things like the equities markets and the bond markets. Slightly different drivers in both. But as a result, that means that it doesn't necessarily rise and fall at the same rate as the equities and bonds markets, and that leads to better diversification characteristics and ultimately a lower risk profile.
And also, you get a good diversification of your income stream as well, don't you?
Absolutely. So with a balanced fund like mine, you're exposed to a wide range of sectors, which we will choose the exposure to depending on how we perceive the risks and opportunities within those sectors. But ultimately, the tenants that are providing you with your income stream through rents are from different industries, whether that's retail, leisure, industrial, offices, serviced offices, self-storage. There's a whole range of parts of the economy that we can tap into for different types of income stream and for different resilience of income stream. Certainly in recent times, we've been positively surprised by the resilience of the residential market. I've mentioned that already, but we've seen there that occupiers, Joe Public, effectively, has been much more quick to pay their rents and much more reliable in paying their rents than some of the bigger corporates, which might surprise some. But it's that sort of resilience that we're drawn to at the moment. Certainly seeing it in residential, offices and industrial as well.
So you talked about rent and tenants. How has that been over this difficult last 6 months?
I think in the whole, it's been a very positive experience. It's really been a test for how we engage with our tenants and a test of the strength of the relationships we have with them. But in the whole, I think our rent collection has been strong and has been getting stronger in recent quarter. At the start, we engaged with our tenants to make sure that they were capable of survival. We had discussions with those that were cash flow challenged, and made sure that we engaged with them to agree rental repayments at a speed that they could afford. And that's really helped to make sure that they can survive all this and be with us for a much longer time. The last quarter, so the September quarter, we started to see the rent collection rate increase further back towards more normal levels, and we're pleased with that.
And we hear broadly about acceleration of structural changes in the way we live and the way we work. How do you see that playing into the UK commercial property market?
Yeah, I think this recent period has probably accelerated a lot of the change that was beginning to play out in the market over recent years. So we've seen retail and leisure struggle in recent years, and that's really been accelerated by this recent period. It's naturally placed a lot more pressure on the retail and leisure sectors by effectively forcing them closed. But by the same merit, it's also changed how we use the office. It's changed how we engage with our home environment. So we're seeing an office population that is adapting and getting used to a lot more flexibility in how they work. Not just the number of hours that they work, but where they work as well. And that has also promoted the idea that actually your home is more than just a home for some office workers. It's an office environment as well. So we'll see changing habits, changing demands in the residential area for the amount of space that people need. For those that are office workers, they might have a greater appetite to have a study area. For those that are in flats at the moment, they might have a greater appetite for more outside space. So these are likely to accelerate the changes within the built environment. And naturally, as a balanced fund manager, we need to adapt to that as well.
Matt, thank you very much for your time this morning. For more information on the Legal & General UK Property Fund, please visit chelseafs.co.uk.